Secondary market section. Once a loan is originated on the primary market, it may be sold on the secondary market. The secondary market is where lenders and investors buy and sell existing mortgages or mortgage-backed securities, thereby providing greater availability of funds for additional mortgage lending. The secondary market is the resale marketplace of loans. Prior to the stock crash of 1929, most lenders required a borrower to have down payment of 20 to 40%. If that was the case today, not many people would be able to afford a home. Not only did the lenders require a large down payment, but the loan was a straight mortgage, which meant they would only pay the interest. The term was typically 1 to 7 years, and at the end of the term, if the borrower could not pay the entire balance, a new loan would be negotiated. After the stock crash, the government needed to stabilize the economy and stimulate the stock market. In 1934, the government introduced FHA insured loans. The FHA's primary purpose is to insure lenders from loss. The FHA made it possible for people to purchase a home with a smaller down payment. A smaller monthly payment would be made to the lender over the course of 30 years. A portion of the payment would be applied to the principal, and the remaining would be interest. A 30-year fixed-rate mortgage with monthly payments was a new concept at the time. To reduce the risk to the lender, the FHA required the lender to verify the borrower's employment, have the property appraised by a neutral third party, and have a title search. If the government guidelines were met, then the lender would negotiate the loan. The lenders and the government knew that within 30 years, the borrower might default on the loan, so the government insured the loan. The borrower was charged a one-time upfront insurance premium based on the loan amount and 0.5% annually on the loan balance. If the borrower defaulted on the loan and the loan amount exceeded the price of the property, the FHA would pay the difference. By 1938, the lenders who offered the FHA-insured loan had a problem. Banks can negotiate loans on a percentage of their deposits. Due to the popularity of the 30-year fixed-rate loan, that percentage had been reached. Banks did not want to have to turn anybody away because all the money was loaned out for the next 30 or so years. So, in 1938, the government created the Federal National Mortgage Association, or Fannie Mae. This was to buy FHA-insured mortgages from lenders. This would provide lenders with a rollover of funds, so they wouldn't have to turn any potential borrowers away. When veterans returned to war in 1935, Fannie Mae agreed to buy VA-guaranteed loans that lenders had negotiated. Eventually, Fannie Mae started purchasing loans from lenders if the loans met Fannie Mae guidelines. Today, Fannie Mae is a quasi-government agency that is privately owned, and Fannie Mae stock may be purchased on the New York Stock Exchange. Fannie Mae buys mortgages on the secondary market, pulls them together, and then sells them back as mortgage securities to investors on the open market. Monthly principal and interest payments are guaranteed by Fannie Mae, but not by the U.S. government. In 1968, Fannie Mae was split, and the Government National Mortgage Association, or Ginnie Mae, was created. Ginnie Mae is a federally owned corporation in the Department of Housing and Urban Development. Ginnie Mae administers special assistance programs. The main focus of Ginnie Mae is to ensure liquidity for U.S. government-insured mortgages, including those insured by the FHA and VA. This concludes the section on secondary market.